every mother-son is selling Alibaba now. SoftBank, Ray Dalio, First Eagle. Who's next? Charlie Munger? So Munger might very well be our very last gatekeeper. So if he sells out too, then I guess we most probably would have seen the bottom for Alibaba. So truth be told, I'm sure it doesn't feel good to be stuck back holding equities when you see these supposed smart money leaving the stock one by one. So on the flip side, I guess some will see it as a contrarian indicator. So when even institutional investors loses hope, that's when you exhaust most, if not all of the different sellers. So the last thing we should lose is actually the like button. So remember to add the like button into our bags by smashing on it. Also, this video is sponsored by Weibo. Every single new sign-ups can get up to 100 USD worth of Google shares. I'll leave the link and instructions down below. Essentially, you just need to deposit a minimum sum of 2,000 Singapore dollars and execute a total of 6 trades in the first 30 days. That's an 8% ROI in 1 month. Definitely better than Alibaba. Jokes aside, Weibo also allows for investing into fractional shares. And I don't know why this is not a common feature for other brokerage platforms. So they pride themselves in zero commission trading as well. Don't let this 8% ROI deal get away. Link in the description. Now, getting back to the video. Largely speaking, I think funds trading in and out of positions are pretty normal as they attempt to quote-unquote seek alpha, but just a word of caution. So although funds buying into specific companies can be huge value signals, because at the end of the day, most, if not all of the fund managers out there buy stocks to make money for their investors. But there might be more than 1,001 reasons why they might sell them. That said, however, there were many instances where fund managers admitted that it might have been an error in their judgment or due diligence. And the most recent saga that most of you would remember was Bill Ackman and his Netflix purchase. So long story short, there isn't a simple conclusion. Companies that are endorsed by all these so-called super investors might or might not make a good investment. So circling back to this huge Alibaba dumpster fire, in the grander scheme of things, even if Munger were to sell out of his position as well, it would have a greater signaling effect compared to real-world price implications. So on one hand, Munger currently holds around 300,000 BABA share under the Daily Journal Corporation's portfolio. Dalio, on the other hand, in the Bridgewater portfolio, had around 7.5 million Alibaba shares. So they pale in comparison to SoftBank's exposure in Alibaba. Hence, the main culprit for the weakness in the price action was mostly attributed to SoftBank entering into a prepaid forward contract with their Alibaba position. So what exactly is a prepaid forward contract? So it's basically a complicated derivative that allows the said investor to hedge their exposure on the underlying position or the underlying stock. Long story short, the investor, which is SoftBank in this case, is selling the stock to the brokerage company, but the transaction is not yet finalized. So this essentially provides SoftBank with a guarantee that they will be able to sell the Alibaba share within a range of prices that are predetermined between them and the brokerage firm. So a prepaid forward contract involves a floor and a ceiling price. So to give you an example, let's assume that the agreed price range for Alibaba is $100 to $120 in 1 year's time, and SoftBank decides to engage Goldman Sachs for this transaction, just for an example. Now, as SoftBank pledges 242 million BABA shares, the contract would have an agreed upon percentage paid to the investor immediately. So let's take an example of 75%. So assuming that $100 is the agreed price, 242 million shares times $100 works out to be around $24.2 billion. So 75% of that amount is around $18 billion. So Goldman will essentially hand SoftBank $18 billion first, and the 242 million Alibaba share will essentially act as a form of collateral for them. So in 1 year's time, assuming that Alibaba remains beaten down and is currently trading at probably $20 or something, Goldman will still have to cough out the remaining 25%, and SoftBank will happily walk away with the $24.2 billion that was initially agreed upon, while handing the shares to Goldman Sachs. On the flip side, however, if Alibaba moons to $200 in a year's time, SoftBank could either pay the differences in cash to Goldman to settle the outstanding contract depending on the terms of the contract, or just hand over the 242 million shares. while Goldman will pay them the differences between the 18 billion that they first gotten and the agreed upon $120 times 242 million, because it's essentially where the upper bound of the contract was set. And that's essentially how the derivative actually worked. So from SoftBank's perspective, it's a win-win, because ultimately, they don't have to directly sell their shares now, and the physical settlement would eliminate concerns about their future cash outflows. And they can of course immediately book the profits on their books. So it essentially helps them shore up cash in the short term as well. So for context, SoftBank bought into Alibaba for $20 million in the year 2000. And this reduction in stake from 23.7% to 14.6% of the company will allow them to book an unrealized gain of around 34 billion USD. However, if you were to look at it from Goldman's perspective, this contract essentially acts like some sort of a call option for them if it's unhedged. So Goldman definitely hope that the stock will keep appreciating so that they earn the spread from the agreed price band and the actual share price itself. But what if the stock price never recovers? And like I said, Alibaba trades at $20 from a year now, even after the deadline. So I doubt these banks or brokerages are going to enter into this contract with SoftBank unhedged and essentially underwrite the risk on their own. So the two most straightforward way for them to hedge their position is to either short the stock in the open market or buy a put on the position to protect the downside risk. So besides, where do you think these brokerages get the initial $18 billion to pay SoftBank? From their own books? Fat hope. Unless these brokerages are extremely bullish on the underlying company and thinks that Alibaba will moon before the contract expiry. If not, they're just here to earn the commission and the spread. They're not going to underwrite such a great deal amount of risk. Hence, even though SoftBank did not officially sell their position in the open market, by essentially going into this contract, by extension, has already caused a huge selling pressure on the underlying stock as these underwriters hedge their position in the open market, which is kind of equivalent to them selling beforehand, if I can put it that way. So what does this mean for investors? So the short answer is, it means nothing to you and me. From a business perspective, especially for avid investors who follow SoftBank closely, it is kind of a justified and a prudent decision for them to do what they did with the Alibaba position. And besides, it's not the first time, and especially so in today's environment. So they essentially booked a $50 billion loss for its Vision Fund investment arm in the first half of the year, as most of their tech bets went south. So if the investment company is going to go under, I don't think he has an obligation to hold on dearly onto the Alibaba position and not sell. So it's an investment, not his wife. That said, I think it's quite a waste, particularly because he isn't exiting at the upper bound of Alibaba's historical valuation. But hey, who knows? This might be the highest Alibaba will ever see in the upcoming decade. Touch wood, of course. Also, since not every investor is like Bill Ackman, who publishes his thoughts on why he buys or sells a certain security, many investors at the sideline tend to just think deeply behind specific actions of these investors or fund managers. And Munger's maneuvering of buying and then doubling down and then selling 50% of his Alibaba stake is a case in point. So I know I haven't really talked about Bridgewater selling out of the Alibaba position in this video. I promise it will be next. So at the end of the day, unless one of your investment thesis is, I own Alibaba because SoftBank or Ray Dalio or Munger owns it. If not, what's broken? Oh, Munger is still in, by the way. I'll buy left with 50%. But for now, the thesis is partially intact. That said, that's a dangerous thesis to begin with. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!